welcome back to our investing second important concept for you to understand. Yesterday, we talked about the big deal of investing because of the amount of interest that you can potentially earn on the stock market in comparison to transaction accounts and savings accounts. The maximum amount of interest you are going to get most of the time from a savings account is somewhere between 3 and 4% when cash rates are where they are right now in most countries. So most countries are at a 3 to 4% cash rate, and that is where your savings are anchored. When it comes to the stock market, though, the interest that you can earn on the stock market can be upwards of 8%. In fact, did you know that the stock market in the 100, maybe a bit more now, 100 odd years since the stock market was started, it has performed consistently at 10% per annum. So that is pretty incredible when you think about the 4% in your savings account to the 10% on the stock market. But it's not that simple, because when it comes to savings accounts, that money is not at risk at all, really, other than a zombie apocalypse. When it comes to the stock market, though, what we need to talk about is risk. So when we are investing on the stock market, we are making a bet on a company, because that is what the stock market is. It's made up of small pieces of companies who have decided to sell a small slice of their company. Now, what they're getting from that is money. Okay, so you are absolutely taking a risk on that company. There are no guarantees that you are going to keep your capital, that you're going to make any interest whatsoever. What we have to think about is that while the stock market has a massive potential for reward, depending on a few factors, there is also a much bigger risk. High risk, high reward. Low risk, lower reward. I think that's pretty simple. It's pretty straightforward, and it's something that we can all get our heads around. So that is all I wanted to talk about today, is that concept of risk and reward.